Welcome to the Sojourn Wealth Management Podcast. My name is Jeff Bronner, and I'm here with my co-host, Corey Akins and Andrew Kraft. How are y'all doing today?
Doing good, Jeff. Had a fun weekend of golf and played a lot of golf over a 2-day period. So I think 54 holes in total. So I'm a little sore, but man, it was great weather after the thunderstorms rolled in.
How'd you play?
Next question. I played okay, you know. I mean, it's the first kind of round of the season.
I think you're being bashful. I think you told me you won one day, right?
Yeah, we won. So we do like an annual trip with some friends from college, and we do like a scramble 2 versus 2, and so it was fun. We won. I won one day, lost the next, and then the final round, we just kind of, frankly, trying to get back to the condo. How about y'all? How was your weekend?
Had a great weekend as well. A little different though. Helped host a ladies' brunch Saturday morning.
That is very different. Yes.
And so spent most of the time upstairs with my youngest son, but I did make the coffee for the ladies. So that was good. And did some weeding, you know, because the rains caused a lot of those to pop up. And then Sunday, great church service. Pastor wrapped up the book of Ruth, so great talk on the kinsman redeemer. And then got home and got to watch Liverpool play and win the Premier League. So that was fun.
You know, Andrew, if you want to get audio into the podcast, you don't have to play it on your phone and hold it up to the microphone. We can get it in here.
I think that was a YouTube video. It wasn't even just like music. It was like an actual YouTube video.
Yeah, I'm not very technological. I'm glad we don't have videos in here. But yeah, it was good. Good weekend.
Good. I did some landscaping as well. After all that rain, our
Thank
grass...
you for pulling weeds landscaping. I appreciate that.
Well, after your ladies' brunch, and then you're weeding the garden, I thought I'd, give you some credit. But yeah, I had to mow the grass because it was just out of control, and I have terrible allergies. So after all of the rain and everything, and then I mow the grass, I was in poor condition. So much so I help with worship at church, and I was up there and open up your hymnals to hymn number yada yada, and just really nasally. My pastor came up afterwards and was like, "Are you getting emotional during when you were leading worship?" Which is that's not an unfair assumption, that could happen. But I was like, "No, I'm horribly congested right now, and I sound terrible." So hopefully for our listeners, that's not coming through so bad today.
Yeah, you sound pretty good.
Well, good, thank you. Well, we have a lot to talk about, so we should dive right in, shall we?
Yeah, man, what a last few months, right? Like wild ride.
First trimester, right?
Yeah, right.
Something like that.
Yeah, I think I know you guys have. I have too. We've received a lot of calls from clients, non-clients, just people interested in what's going on and asking questions about kind of the up and downs of the market and how that's affecting everything. And so I really thought an episode on what's been happening those last 3-4 months has been going on would be helpful. And so the goal for today is really to provide folks with a clear understanding of Q1, market dynamics, some asset classes that have been resilient, strategies, and then talk through some of what's causing that uncertainty. And so jumping on in, the primary driver behind the policy uncertainty has been President Trump's announcement of the tariffs that took effect in early April. This was really when we saw the market go down, and once he did that, a lot of countries started coming back to the table and saying, "Hey, we would actually like to negotiate." And so then you saw the market kind of rise back up after they had pulled those back a little bit and started negotiating. But that has really been where that market volatility has come from, because I think investors are just uncertain of what is the path forward. And so it's had a broad and far-reaching kind of effect. And so hopefully today people will have a better understanding of it.
Yeah, absolutely. One of the interesting things with the last couple of months, specifically in relation to the tariff policy, how it's been rolled out, is a lot of it has to do with communication. And one of the things we'll get to, and I know you got a lot of data and historical data for us to look at together, Corey, but the way in which it's communicated and then recommunicated through different media and things like that has an effect on the market.
Yeah, that's a great point. So it's probably helpful too, just to unpack what our position as a country has been on tariffs the last 100 to 120 years. So I think
since the Tariff Act of 1789, you're going to go through year by year how that's
quarter by quarter.
Even better, more detailed.
That is not in play today. We will not be doing that. But really, how did we kind of get to the place where we're at? So for most of the 20th century, the U.S. operated in a trade surplus. So we exported more than we imported. So that was kind of the way that our economy was set up. After World War II, that's even bolstered because we are then leaning into that strong manufacturing base, providing a lot of goods for countries across the globe to rebuild. And then all of a sudden that started to change in the 70s. You see the oil crisis, and then that actually progressed in the 1990s, where you have the NAFTA, or the North American Free Trade Agreement, and then the creation of the World Trade Organization. And that was really where we started to see kind of the globalization of trade. And so, in tariffs, right? So, as we have kind of gone below that 0% line into the negative percentage range of imports to exports, kind of outweighing China, is obviously going the other way. And so the focus has been the last several years to kind of bring us back to a place where we are actually manufacturing more in the U.S. And that is regardless of political alignment. That is something we saw in the last administration that had been carried over from the previous administration before that. So there were some things that President Trump had done. Then President Biden actually allowed those to continue, and then those are obviously being built upon now. But there has been that focus. I think when you get globalized trade and what we had seen, you do have cheaper goods and a little bit less barrier there to those goods. But it does create things like in 2020 when we saw COVID happening, the supply chain issue, where you have basic goods that you don't have access to because there are weaknesses in the supply chain because we don't actually manufacture a ton here.
Yeah, I remember throwing wrapped up toilet paper as birthday presents to people.
Like from your car as you drove by.
Right,
like, no, we're not TPing your yard. We're just actually providing you a good.
Yeah. That was a big, I think, reason for that. And you mentioned NAFTA. And I remember when that was coming online, and the idea was, free market, division of labor, goods will be less expensive, that kind of thing. In between, I guess, Canada, U.S. and Mexico, that began to happen. But then, like you mentioned, a lot of the goods were being produced outside of the U.S., and so our trade deficit began to increase.
Yeah, absolutely. And it's interesting too because it's complex. Like the U.S., our top exports are energy and autos, and our top imports are also cars, autos, and energy. Right, so it's a system that is got a lot of layers to it. But really, the purpose of today is just kind of provide that brief overview, and then talk more about the economy and the markets because that policy uncertainty affected that. Right, so markets you kind of see volatile go down. As they're enacted, reacted, and came back up as some were peeled back. And I think it's important to remember that when you talk about tariffs, it's not like they can't be undone. So, I think,
great point.
I think personally that is really the chief end that the administration had, was to just say, hey, we want to negotiate and we want to come to the table with prices, percentages that are going to be fair. And it's had that stated effect. I think like 70, 80 countries have reached out since the tariffs were enacted.
I think you're absolutely right. That negotiation was a big part of it. I think there's also another part that I've read about that is just simply for national defense, that there are some industries that we're going to keep the tariff on there because the idea is that we've got to bring them back home and have those things produced here. Like there's a chip or semiconductor or something that China produces that helps us run our nuclear submarines, and that's not a good place to be in. So
I think it's the same with pharmaceuticals as well. If there was ever to be a situation where a country would be able to restrict that from us, we don't want to be able to, or be at the behest of another country in order to provide like a necessary product like
country
that.
releases a virus and then they don't give us the medicine for it.
That kind of thing. Yeah.
Yeah. So the economy in conjunction with the market, because it's really easy to kind of connect the two, right? And they are very connected. But the economy, even though the market has been very up and down, it's been strong, right? So the economy is resilient, robust, and I think even with some of the uncertainty that we've seen, will continue to be so. Like you look at the job market in March, it outperformed everybody's expectation. Inflation still kind of high, but the Fed is nearing that 2% target.
But still kind of high, but a lot lower than it was.
Yeah,
right?
absolutely.
So-
Absolutely. And relative to where they want it, right?
Yeah.
So, and so like unemployment's 4.2%. And so I think that you couple that, there's reason to have like good feelings about where we're at as a country and why kind of, the short-term volatility may be a little bit painful, but long-term, I think there's certainly some actionable items we'll take away from today.
Yeah. And you mentioned earlier, Corey, the complexity of the situation. One of the things I want to talk about is the difference between the economic things that you're describing there with like labor projections and unemployment rates and those kinds of things, jobs reports and whatnot, kind of those economic data points versus what we see as market performance.
Yeah.
And how the market reacts to specific events and specific policies and things like that. And that doesn't necessarily mean that the economy's in bad shape.
Mm-hmm.
And one of the things I want to point out is the current context we're in with the way in which we assess market health is a lot more focused than we might realize. And what I mean by that is when most people talk about the S&P 500, for example, that is an index that is an aggregate of a number of companies, but it's most heavily driven by the growth of 7 companies. And these 7 companies are called the Magnificent 7.
Talking about the Yul Brynner and Steve McQueen classic Western? Is that with Charles Bronson? And is that what you're talking about?
No, that's not what we're talking about. The Magnificent 7 or Mag 7 are 7 companies that are specifically tech companies that essentially make up the majority of the growth that the S&P 500 has seen over the last couple of years. And those 7 companies, and not looking at them, so tell me if I'm wrong on any of these, are Alphabet or Google. So Google is one, Apple, Microsoft, Meta, Amazon, NVIDIA, Tesla.
Got it.
Those are the 7.
Well done.
Boom.
And those 7 companies have really driven a lot of the S&P's performance over the last couple of years. And the tariff situation.
And how many are in the S&P, roughly?
About 500.
So
was
those
the
7
number. Yeah,
out of-
7 out of the 500. And over the last couple of years, those companies have done very well. And then the beginning of this year, with a couple different kind of overlapping instances, the first of which I would say would be the release of DeepSeek. So these American tech companies really monopolized the AI market. And then a Chinese company releases DeepSeek, and that shakes the confidence in the domestic dominance, the American domestic dominance in AI. And so you saw some of those, the valuations drop a little bit with that release. Not a huge impact, but it was something that was kind of shook the foundation a little bit. And then you get into the announcement of tariffs. And we've already talked about the impacts that has on things like semiconductors and then other valuable materials like rare earth minerals that are essential to creating this highly technological products like electric cars and cell phones and things like that. And so when those tariffs are announced, it has an outsized impact on the S&P because the S&P is already heavily weighted towards the tech sector.
Yeah.
And the reason that this is important for someone who's looking at their first quarter 401k statement is because a lot of us are invested in the S&P 500 just from an index standpoint, or if you're in like a target date, if you're in just like a 60-40 portfolio, a lot of your equities or stock are going to be weighted towards something like the S&P 500. And with that all drifting towards these 7 stocks, 7 specific companies, and then these tariffs are released, that has a compounding effect on the volatility that an individual investor is going to feel.
So someone might not necessarily have a goal or try to be heavily invested in this tech sector or those 7 specific companies, but kind of what you're saying is because they've grown so much as an outsized part of the index, they effectively are. And it kind of makes you think that it's a accidental replay of the tech crash in 2000 when people were purposefully investing in specific companies leading up to March of 2000, and that one sector went down. Here, that sector is affected, but like you said, the whole index goes down.
Yeah, I think if you look at it, the S&P 500 had over half of the companies, I think they had a positive quarter. But because of these 7, you saw a double-digit drop in the index. It also is coupled with the fact that there were high earnings expectations that were associated with these 7 companies, and that has been the case for the last several years as well. So it makes sense that policy uncertainty, market volatility, these are going to lead the way, both up and down, right? So it's an interesting topic.
And for this might be the first time for a listener. This might be the first time that you've heard that articulated regarding the Mag 7, the Magnificent 7. You might have heard that phrase before, but how that actually impacts like individual portfolios, that might be the first time. But we've talked about that in our firm. We've talked about, we hear that in different investment managers talking through those things. Like this has been a known phenomenon. And so it's something that everyday investors don't interact with.
Yeah.
So
how do you typically kind of counteract that?
That is a phenomenal question, Andrew. And I'm so glad you asked it. So one way that we want to help folks strategize, plan, is to build a diversified portfolio. And typically, in historic sense, if you were invested in the S&P 500, there would be a fair level of diversification because, again, there's like 500 companies roughly represented in that index. But since all of the growth earnings have been largely driven by these 7, portfolio managers have moved more and more heavily weighted towards that tech sector specific holding so that they don't miss out on the gains that the S&P's getting outright.
The FOMO.
Exactly.
I think.
Yeah.
Exactly. And so diversification from an investment standpoint is critical.
Yeah, it absolutely is. I mean, if you look at international stocks over the last 20, 25 years, domestic stocks have outperformed them until this quarter. International stocks came back. They had a better quarter than domestic stocks. And I have actually heard folks talk about the idea of just why even need international anymore, right? Let's just be domestic based U.S. equities and go from there. I think it speaks a little bit to that sense of, you want a broader array of investments that when one portion is going down, another is going to typically rise. Right. It's the same with bonds. So stocks and bonds, stocks just being kind of the equity piece. You own equity in a company through stocks. You are a debt financer in a company through bonds, right? And that's kind of the fixed income piece. And so those are correlated, right? So when bonds go up, stocks go down, stocks go up, bonds go down. Bonds had a great quarter as well. So they did what they were supposed to do in a portfolio that is diversified. So I've got a stat here. If you had just a 60-40 portfolio through the first quarter, you were stabilized and around 1.5% is probably the average loss there because you had that built into it.
Which is probably not what a lot of folks saw when they opened up, like you said, the first quarter statement. And, you mentioned the international earlier, and Jeff and I were talking, I think, at lunch, that I don't know if it's still the case, but French's mustard, which is a pretty kind of all-American, put on your ballpark hot dog, that at one point, and perhaps still is, owned by, I think it was a French conglomerate, and then we got Nestle's chocolate, and of course there's a lot of Toyotas on the road.
Yeah.
So there's plenty of companies domiciled offshore that are good investments.
Absolutely.
We don't have to dive fully into what I'm about to bring up, but there is something to be said about the different types of risk and how diversification protects you about not just from market risk, but specifically, Corey, what you were pointing out earlier is that what we've seen over the last couple of months is policy risk. A new policy is put forward, and that has an impact on specifically domestic stocks. International stocks were not impacted in the same way. And so there's not just market risk, there's a lot of different types of risk, and we have to mitigate those as we work with folks. But this is just one good example of how a diversified portfolio will protect you not just from market risk, but also from something like policy risk.
And you mentioned another analogy, which I think, we're in baseball season. I think you kind of mentioned something about a baseball. You want to unpack that a little bit?
This is one of your greatest analogies, Andrew, and I stole it from you. So I want to hear you articulate it. The window analogy with market.
I was not setting that up for me to go through this. But the classic window pane.
Teed himself up.
So, you think of just 9 boxes, and if you kind of go top to bottom, you have big companies, medium and small size companies, and then left to right, different investment philosophies, value, blend, and growth. And so if you have those 9 panes and the baseball goes through one of them, you just got to replace that one pane. Whereas if you have a big picture window and ball goes through that, the whole thing has to be replaced. So it just kind of helps protect.
Like our office windows.
Like in our studio right now.
Yeah. And to translate that and make it applicable, like let's say this year, you were 100% invested in tech because it had just been booming the last couple of years. And then all of a sudden, all of the tech stocks take a pretty big tumble for all the reasons that we've already discussed. Well, then your whole portfolio is tumbling with it. But if the tech is just one pane of that window, well, all you have to do is replace that pane.
Yeah. And multiple indexes. It's multiple indices, right? So you're looking not just at the S&P 500, but Russell 2000. There's multiple indices out there that you can be in that will help diversify as well. And then you even talk about difference in company size, right? So mid cap and small cap and large cap, and that plays a role in that as well.
Yeah. And when we talk to individuals, the first thing we have to figure out is what are your actual goals? Because what the market's doing right now should not dictate what your portfolio should be doing. But your goals and what you're actually wanting to accomplish is going to tell us, well, this is how you need to allocate. You need to be more aggressive. You need to be less aggressive. You need to see or put it, this is how you need to divide up these different asset classes, large, mid, smalls, so on and so forth.
Yeah, this is what's going to help you get to your long-term objective or mid-term or short-term objective. That's right. Yeah. So how do you take those asset classes and then curate them specific to the client's needs and objectives and desires?
Yeah.
Right. And that's ultimately what our job is. And I personally, like we've talked about this, just, with everything going on with large cap, we've been proponents of mid cap, right? So those companies that are kind of, the $2 to $10 billion range, not the large giants like Amazon and NVIDIA and those, but also not small, super volatile companies as well. And I think there's probably a place, moving forward for those companies.
Yeah. The terms y'all just mentioned, goals and objectives, and those are so key. And I think helping folks unpack those and make those personal are what's important. I know, Corey, you mentioned that, when you kind of give some actual items later, but before we leave this idea of diversification, I want to cast your memory back to high school chemistry class.
Okay.
which is not an enjoyable memory for me, but I'm interested in this idea that when you take these I'll just go with these 4 different, I guess, chemicals or from the periodic table. Elements, thank you. Iron, subject to rapid corrosion. Carbon is really soft. Chromium is powdery and flaky, and by itself, nickel is really malleable. But, when you're putting those all together, even though they're not particularly strong on their own, they create stainless steel, which is really strong and won't corrode. And so I think that's kind of this idea of building a portfolio that not necessarily is a guarantee against loss, which diversification doesn't do, but it does kind of like, provide a couple of pistons. Like Corey, you've mentioned this analogy of an engine and having when one's going down, the other one's going up. And so that's what we're trying to do is kind of help kind of give you the idea that if you don't have all your eggs in one basket, you can have it diversified and kind of weather the storm.
Yeah. Mm-hmm. So what, right? Right. What now?
So let's say that one of these phone calls come in or somebody's asking us this question of what are your guys' thoughts? What do I need to do? What would you guys answer to them? What would be the next step? What's the actionables that people could take?
Yeah, I think we've mentioned before, expertise is the combination of knowledge and action, right, together. And when somebody is calling, or even if you're listening to the podcast and you just have questions, I would say the first thing is working with an advisor, having enough cash on hand to buy the things that you need if something comes up. And then lastly, just stop looking at it. Like, work with an advisor, have the plans in place, agree to the intent behind the portfolio, and then go and live your life and enjoy it. And stop logging in and looking at it every day.
Amen.
Because that gives us a sense of control, it gives us a sense of control over something that we cannot control. And again, you have to just trust the process. And so that would be my answer.
Yeah. And if you can put something inside kind of 2 overlapping circles, like what's important and what you can control, like that's what you should focus on.
Exactly.
Right? And otherwise go swing a golf club or pull a weed or.
Yeah. Absolutely.
So to break that down, if it's not important and it's not something you can control, then don't spend time obsessing over it.
And real quick, you asked what we would say to someone, and I think the key is when you need the funds, right? If you need the money pretty quickly, then possibly you shouldn't have had it in the market. You should have an emergency fund set aside to take that cash from. But hopefully you're looking at an account statement for an account that's going to fund some goal that's further out. And so you can kind of let that market come back and weather the ups and downs in the meantime.
Yeah. And to kind of bring it full circle, I think that even with some of the policy uncertainty that we've seen in the short term, again, long term, I think the U.S. is positioned well to long term continue to see growth and ultimately it be a good time period that came from this.
Yeah. And Jeff, you've mentioned this before, how the market really doesn't care who's in the White House or Congress. It just, it goes up and down with both. And while each catalyst of a market drop, bear market, correction, while each of those may be different, the end generally is the same with the market recovering and going back up.
Right. Yeah. If you took an S&P 500 index history year to date this year, you'd be like, wow, the S&P does not perform well. But then you zoom out 10 years or 15 years, 25 years, and then you start to see, well, this has been there's peaks and valleys, but it goes in an upward trajectory.
Mm-hmm.
And so what I hear you guys saying is essentially, meet with an advisor, have a plan. And what's interesting is we've had this question posed to us from different folks. We mentioned that at the top. But there's a different attitude from those who are planning and have a plan and feel confident about it.
Absolutely.
There's a different character to the question versus someone who doesn't. And so our kind of final appeal to the listeners is if you feel like you're in the second category of folks who you are anxious because of the different ongoings in the market and things like that, we don't want you to feel that way. We don't want anybody to feel that way, which is why we want people to talk to an advisor, to meet with somebody, and to have the peace of mind that comes with that level of planning. Well, thank y'all so much. It was good talking through this with y'all.
Yeah,
thanks, Jeff.
Thank you for listening to this episode of the Sojourn Wealth Management Podcast. This is a friendly reminder that all content in this podcast is intended for educational purposes alone. Nothing in this episode should be treated as tax, legal, or investment advice. We encourage you to consult your financial professional for any of those needs. Securities offered